I guess I'm really lucky compared to a lot of investors, and I get to talk to these fund managers and interview them face to face and get to know them over a period of time. Past performance isn't a guide to the future. The way that we would think about past performance is it gives us a frame of reference as to the type of performance you should expect. When should it do well? When should it do badly? And the more you can read about fund managers' comments about what they're thinking of the world and their fund, the more videos you can watch, the more you can upskill yourself and immerse yourself in that, the better investor you're going to be.
Well, hello to all of our listeners and also our viewers on YouTube. This is the Steps to Investing podcast, and I'm your host, Marcus De Silva. Today, we're going to be exploring how to set about finding some really good actively managed funds for your ISA, maybe your SIP, as opposed to just selecting cheap index passive trackers. So actively managed funds is where you've got a stock picker, a human stock picker, who is selecting certain companies out of a particular market with the idea that that collection of companies will beat the market that they're selecting them from. And I wanted to explore this because there's a lot of them out there. There's about 5,500 funds. There's about 400 investment trusts out there. And the figures frequently show that the majority do not beat the sort of passive equivalents after fees. So that said, a really good active manager can certainly grow your wealth way beyond a passive. So it's really important to select a really good active manager. So I've got someone on the podcast to help with exactly that. He spent his career analysing funds. He's the head of investment partnerships at AJ Bell, and he's back on the pod. I'd like to welcome Ryan Hughes. Ryan, welcome.
Hi there. Thanks very much for having me back.
Should we start with some background? Ryan, how long have you been looking at funds for?
Yeah, I suppose the formal part of my career, I've been fund researching for probably about 20 years, but my career goes back longer than that. We're approaching 25 years now, which means I've seen a few crises and a few cycles. So I'm starting to feel my age, to be honest with you.
Okay, interesting. So I wanted to start with you, when we're thinking about choosing some funds for our portfolios, what is your view on this kind of, it's a much talked about, this sort of active versus passive, the kind of index debate. What's your view on this?
Yeah, I think in many respects, the debate it's almost become too polarized. I don't like the narrative of active versus passive, which tends to be how it's always framed. It really should be, in my view, active and passive. Now, if you'd asked me 20 years ago what my view was, I'd have said it's very much active versus passive, because I was kind of trained to think that active managers could deliver outperformance consistently, and therefore, if you're researching investments, it's a kind of dereliction of duty if you went down the passive route. But things have moved on a lot over the last 20 years. The beta element, so buying market exposure, buying a passive, has become so much cheaper, and that makes the bar for good active managers higher, and the bar for bad active managers even higher and even harder for them to achieve. But I do think it's really important that we think about how they can work in harmony. Maybe passive is right for some asset classes. Maybe it's active is right for other asset classes. Maybe passive is right for some investors and active may be right for others. Because it's really important, if you do look at you want to invest in an active strategy, that it's not a kind of one and done. We buy it and we forget about it, because things change. So if you're prepared to do your homework and keep on top of your homework, active management can be a really interesting place to look. But if you're not, and you're not that way inclined, I'll be the first to say to anyone, buy passive, keep it simple, keep it low cost there. But if you're really interested in buy investments and you want to engage with it, then I think there's some interesting places to use active management.
Okay, let's move on to finding some really good active funds then. And there's a few different things that we can look at. And I'm going to start with performance, because the regulator makes it clear that, past performance is not a guide type thing. How important is performance to you? Performance
for me is about informing me as to how the manager invests. Actually, you can use the shape of the performance, the type of performance that you get, to actually educate you as to how the manager invests, what their style is, what their process is, where their bias is lie. Let's get it right out of the way up front. There is no single active manager that will ever be able to outperform every single year. The very best in history will go through long periods of underperformance, and that underperformance might be quite stark. So you've got to go into it with the right frame of mind, in knowing that any active investment you select will have a period of underperformance. The key is understanding when that underperformance should happen and is likely to happen, and therefore can you tolerate that within your portfolio. So we do think about performance. I do look at performance, but in many respects, it's one of the last things I think about, not one of the first things I think about, because I want to understand how a manager invests first and foremost, and I simply use performance and past performance as a way of educating me as to whether I've really understood that.
Okay, so I suppose there are periods of time where, a manager might have a particular way of investing, a particular style, and there are periods of time in markets where styles can be out of favour. So during those times, you might expect certain managers to underperform. Just on the performance thing, though, do you think generally it's quite good to look at long-term performance? Because that's the really important time frame. We always say that investing is about the long term. So I suppose if you're looking over the long term, that presumably is quite a good indicator of whether or not this manager is going to be able to deliver what you need for your financial goals.
It is. I mean, long term is absolutely key, but what I would think about the long term is perhaps longer than many investors would think about, because really what you're saying is you need a market cycle. If you've only got one type of style that's in favor for a prolonged period of time, then it will be no surprise if a manager that doesn't follow that style actually underperformed for quite a prolonged period. And these styles can last a long time. There might be one style in favor for 5 years plus, in which case some managers will underperform for quite a prolonged period. So long-term performance, looking at that is really important, but you've got to look at it in the context of what's going on in the broader market as well.
Okay, interesting. Okay, well, let's get on to the fund manager themselves. I mean, what sorts of characteristics, what types of things do you look for when you're looking at the bios and you're looking at the fund manager themselves?
Yeah, I guess I'm really lucky compared to a lot of investors, and I get to talk to these fund managers and interview them face to face and get to know them over a period of time. So when I'm analysing them and thinking about them, it's not just about thinking about how they invest in terms of thinking about their performance or their style or the type of companies they have in their portfolio, which anyone can get the information from the internet and fact sheets and so on. I'm really lucky and I get to look them in the whites of the eyes and think about, do they come across as honest? Have they got a hunger and a desire to learn? Are they humble when things are going well? What's their behaviors when things are going badly? So these are all things that I can draw out in my interaction with fund managers on a regular basis. And that of course, that relationship builds up over time, but it is much harder for an investor that doesn't have access to fund managers to be able to draw, in many respects, those softer elements, those more human elements out of it. Because at the end of the day, every fund manager, there's people, even if you're buying investing in a fund that's run by a computer, there's still a computer programmer behind the scenes telling it what to do. So you can't get away from the human element. And every single human has got behavioral weaknesses and behavioral biases. What we're trying to do is identify what those are and really try and minimize them, use managers that recognize those weaknesses. And I can perhaps give you a good example to bring this to life. There's a UK equity manager who's very well known, who has a very particular style investing in value companies. And obviously that's not been a great place to be for quite a long period of time, but it's been better more recently. Now, he engaged an external consultant to analyze every single trade they'd done over a 10-year period to try and work out where their own strengths and weaknesses were there and try and actually improve their decision making. Now, for me, when I'm talking to fund managers, that is a brilliant thing to see, because you want to see that degree of engagement of wanting to improve the decisions. But it's not about finding fund managers that get every decision right. the best fund managers in history are likely to have only got between 50 and 60% of their individual company picks correct. So nearly half of them are going to go wrong. The hit rate, as it's termed, if you've got a hit rate above 50%, 60%, that's pretty good over time. And even the great investors, your Warren Buffetts and so on, will have made many, many mistakes over a very long period of time.
So I suppose if you can find content, materials, videos that enable you to listen to the fund manager and to some extent, like you do, look them in the whites of their eyes and get a sense of whether you trust what they're saying and their beliefs behind their investment process, that's probably quite a useful thing when you're exploring, looking at funds for your portfolio.
Absolutely. You've got to use more than past performance. And they're absolutely right. Past performance isn't a guide to the future. The way that we would think about past performance is it gives us a frame of reference as to the type of performance you should expect. When should it do well? When should it do badly? And the more you can read about fund managers' comments about what they're thinking of the world and their fund, the more videos you can watch, the more you can upskill yourself and immerse yourself in that, the better investor you're going to be.
So I suppose tenure is probably quite an important factor here.
Yeah, I mean, tenure is, for me, when I think about my investments and the funds that we will use in clients' portfolios, I suspect if I looked at it, there's quite a lot of grey hair in the portfolio. We like managers that have seen a few crises that really under, because it's over those type of events that you shape who you are as an investor. I mean, I remember starting out around the tech crash. I started just before technology crash there. So immediately that's going to shape me as an investor. And then we had 9/11, and then we had the Iraq War and so on. And all of these events shape you as an investor and make you hopefully a better investor over time. So if we've got managers that have got long tenure, then we've got more evidence to look at that they stick to what they say they're going to do. We've got more evidence to hopefully identify whether it's skill, not luck, that's driving the performance over the long term. Because over the short term, anyone can be lucky. Being lucky over a long period of time, we all know, that's not really going to happen.
How much do fees matter?
Fees do matter a lot, and they matter more and more, I would say. And that's really because of the point I made earlier around low-cost passive investing actually getting cheaper and cheaper. There's been a price war going on in the passive market for the last 5 or 6 years, and costs are being driven down. We're not really seeing much evidence of that in active management. And as I said, that just brings the bar higher and higher. I mean, ultimately, every investment you make, your first thought should be, how much does it cost me to get that exposure, i.e. a passive? So if I'm buying the FTSE All Share, how much is it going to cost me? Well, FTSE All Share might cost me around 10 basis points to get exposure to, 0.1% per annum. Okay, well, now I'm interested in active manager, but that active manager charges 0.8% per annum. Well, you've immediately got a decision. Do you think that manager over a period of time can outperform the market by 0.7% per annum? And that's a pretty high bar. Now, they won't do it every year, and some years they might beat it by 3, 4, 5%. Others, they might underperform by that amount. But on aggregate, they need to beat the market by 0.7% every year just to match the market. So that is going to be a very difficult challenge for them. So the hurdle rate for active versus passive is very important. And of course, these numbers differ for different asset classes. Bonds have become very, very cheap to buy in a passive structure, very cheap more recently. And of course, the degree of the ability to outperform is perhaps reduced because the kind of levers that a bond manager has to pull are not as extensive as an equity manager. The impact of the bond is not as great on a portfolio if they pick a good one.
Okay, finally, just before we move on to some of your favourite fund managers, the investment approach. Now, you briefly touched on value there, it being sort of a good time for value at the moment. And this is after a long period, really, throughout, ever since the financial crisis, right the way up to the pandemic, where growth, and beyond the pandemic, where growth was really the in favour kind of style. But it can be a bit complex for private investors to understand the difference between all these different styles. Do you think this is very important when it comes to selecting funds?
I think it's absolutely crucial to understanding active fund management, because essentially, when you boil down any active fund manager, they have some kind of style bias. It might not be value or growth. It might be large cap versus small cap. You can slice and dice the market in different ways. But ultimately, just about every single manager will have a bias to some degree or another. There are very, very few managers, I think, that have been able to successfully navigate a changing market over a long period of time. So successfully positioning their portfolio for growth and then calling the end of the growth phase and moving it to value, and then back round that circle we go. I don't think there are really any managers that I know of in my career that have consistently got that right time and time again, in which case you then got to think about, okay, how do I combine different styles of management in my portfolio? Do I want to have a value manager, a manager that focuses on those companies that perhaps are a little bit out of favor and perhaps a little bit old fashioned, but are still making money, or a growth investor that's thinking about the latest exciting things going on in the market and maybe something like technology? Maybe actually a strategy, rather than trying to find one that can move between these different parts, is to actually combine managers together. So you've got a specialist manager on one side and a specialist manager on another side. And actually, you would hope that one of those is performing reasonably well at any time when you look at your portfolio.
So, because it can be a bit complex. We've got an awful lot of things that we need to think about when we're creating a balanced portfolio. We've got a balance across markets, across different assets, across different styles. And I suppose that's the only thing is it can become a little bit confusing when you're sort of trying to create something that is diversified, which is really ultimately the key thing when you're investing.
Yeah, it is. I mean, investment and building a portfolio is a jigsaw puzzle. When you start a jigsaw puzzle, you've got your box full of pieces. You don't know which ones are the corner pieces and which ones are the edge pieces and so on. And you've got to root around and find them. But building your portfolio is no different to that. You've got to work out the types of funds that are going to be your corners. They're going to be the kind of anchor points in your portfolio. Then perhaps you want something that's a little bit more steady, which is going to be your edge pieces of your jigsaw puzzle. And then you can think about the more interesting things that are going to make up the nice picture in the middle. So if you can start imagining the different strategies as different parts of your puzzle, as different building blocks, then I think it's easier to think about how do you combine different strategies. But I would say one of the mistakes that we see quite often is the illusion of diversification. So we look at someone's portfolio and they think they're very diversified because they may have 10 or 15 different holdings. But if they're all invested in the same types of company, there's no diversification at all. So what we saw up until recently was portfolios that had lots of different holdings and they were all focused on growth. And they'd done really, really well because growth had done well. And then all of those holdings did badly at the same time. So you had that illusion of diversification. So you've really got to think about, if I'm wrong, which bit of my portfolio will do well? Which one or two or three holdings will prosper if my general ideas are wrong? So it is complicated, but then I would say if people think it's complicated, they should do a couple of things. They should either buy passive and not worry about it, or buy some kind of multi-asset strategy that does that for you, thinks about the asset allocation, thinks about the building blocks, combines different strategies together, and takes that problem away from you. Because it's a full-time job for me, and it's enabled me to have a career. And you never stop learning in this. You've never cracked it. It really is quite complicated, and it feels ever more so right now in the kind of turbulent world that we're living in.
Okay, well, let's get on to some of your favourite fund managers of all time. You've certainly seen quite a lot of them over the years. So, and I'm going to do this there's a few ways of looking at this, but I'm going to do this from a sort of risk perspective. So we're going to have a look at cautious and moderate and adventurous and an income type idea, just to give people a few different flavours. So let's start in the cautious end. First of all, can you just quickly define what we might, a cautious investor, and then what would you say would be quite a good pick in this sort of area?
Yeah, cautious investors. So we're thinking about people that might be making their first steps in the world of investing. They're moving out of cash. They might be taking out their first investment ISA, or they're just really nervous about investments and don't want to risk too much of their capital. And there are lots and lots of options in this space. You could invest in corporate bonds and government bonds. You could invest in a mix of different strategies. You could even maybe invest in some lower risk equities in that space. So there is quite a broad spectrum of cautious, which will mean different things to different people. For me, a manager that I've respected for a very long period of time, who runs a strategy in this way, is Sebastian Lyon at Troy. Now, he runs the Personal Assets Investment Trust, as well as the Troy Trojan Fund. Now, Sebastian thinks long and hard about not losing money. So the first objective of the Personal Assets Investment Trust is preservation of capital. The second objective is, can I grow that capital? So you can immediately see there's a very clear alignment with that cautious risk profile in how they think about that. Now, Sebastian combines high quality equities with some fixed interest, with some bonds, with some gold and some cash. So if you buy something like personal assets, any investor is getting an instant portfolio. You're getting exposure to different asset classes and really taking some of the headaches that we've just been talking away from you. And when you look at the long-term track record of Sebastian, whether it be his open-ended fund in Troy or his investment trust for personal assets, what you should see and what you will see is it performs very well when markets are falling, when times are tough and things are really uncertain. He's got a strategy that manages to protect investors from the worst of those falls.
Well, I'm just going to quickly jump in there and say, well, if that's the case, how did he do last year?
Well, it was a little bit tougher last year. It was tough for everyone last year, which is a really good point. So fixed interest sold off last year as well as equities. Gold was a little bit better, and some of the bonds, the index-linked bonds, the inflation-linked bonds, in the end recovered quite strongly. So the trust was down. It wasn't down as much as the equity market. But it again proved that no matter how good the fund manager, there is no way of constantly delivering positive returns in a market which is very, very challenging. But coming back to that long term, coming back to that environment of thinking about that long term, then Sebastian has that approach. He's a long-term thinker. He worries lots about risk and losing money. And I think that's a really good starting point for a lot of investors. Yeah, that's a tricky one. I was thinking about this. This is, it really can span all kinds of things. I mean, I guess if we think of it as more of a balance type investor, in my mind, if you think of it at a scale of 1 to 10, we're in the kind of 4, 5, and 6 realm, which is probably pushing us towards some equities, some equity exposure here. And that's where I've thought about a manager that I like in this space, and that would be Alex Wright, who manages the Fidelity Special Situations Fund and the Fidelity Special Values Investment Trust. Now, Alex has got a lot of experience. He's been around a long period of time, so it kind of comes back to the conversation we were having of ticking that box. What I like about Alex is his process is very consistent and very repeatable, in that he's very clear about the types of companies he wants to invest in. So he's a value investor. He's happy to invest in companies that other people are selling and shunning because he sees long-term potential in these companies. He's also happy to invest not just in the largest companies, but invest down the market capitalization. So there is a little bit of exposure to smaller companies in this type of strategy. But again, this is a manager that has, over a long period of time, despite the fact his style has been out of favor for a good chunk of that time, shown that high quality active management can deliver outperformance versus the benchmark. Now, as ever, it's an equity fund. It doesn't look like the benchmark, so it will be volatile. By the very definition of active management, if you want a genuinely active manager, you have to expect the returns are going to be different to the benchmark in the first place. So if you're not comfortable with that, comes back to this, buy passive if you don't want that. But if you understand that it will look different, some years it'll be 10% behind, other years it may be 15% ahead. So you will get that volatile return profile. But Alex, he ticks the box on me of experienced, a very clear process, backed by a well-resourced team, and a very clear conviction in investing consistently in the same style.
Okay, Alex, right there. Fidelity. So let's move on then to the adventurous investor. I mean, how adventurous are we talking? How exotic are the asset classes in the adventurous?
Yeah, I've kept it relatively sensible in thinking about Asia for an adventurous investor, rather than thinking about some really high risk investment, a specialist niche investment. So I've stayed mainstream, but of course, adventurous spans the wide risk there of some really exciting, interesting, maybe something like investing solely in Vietnam or solely in a single sector. I think that might be a step too far for a lot of investors. I would think about those types of investments when you've got a very established portfolio already. Whereas I think for some people who just want to take a little bit more risk, an area like Asia is quite an interesting area to think about, because you've still got, it's very, you can relate to it, and it's got those nice long-term growth dynamics. So the manager I picked, it might sound slightly strange in that I'm not, in many respects, I'm not picking a manager, I'm picking a team, but only because the manager who ran this team for the last 20 years has just retired. And that was Matthew Dobbs at Schroders, who ran their Asian team, but he's been replaced a year ago by Richard Sennett there. And Richard has worked alongside Matthew for, more than a decade. There. So when Richard took over, there was perfect continuity of process and the team and so on. So Richard runs a couple of strategies, but the one I kind of name check would be the Schroder Asian Alpha Plus Fund. And it's also got a mirroring investment trust of the Schroder Asia Pacific Investment Trust. So here, Schroders have got fantastic heritage of investing in Asia. They've got people on the ground in China, in Hong Kong, and across Asia. So they've got good resource, they've got kind of the depth of team and experience that's important there. And again, a process which is a little bit more focused towards growth. But what you see again is consistency of performance there. They're not shooting the lights out when they're winning, but equally, if they get it wrong, they're not getting it wrong by too much. And so you can have exposure to the Asian markets. Again, a manager, you'll see this consistent theme. A very experienced manager backed by a very experienced and deep team who have a process that's well established and got the kind of war wounds of all the troubles that have happened across markets over the years. So it's adventurous, but it's not gung-ho adventurous. It's got exposure to China, it's got exposure to Hong Kong, and that won't suit everybody given the types of things that are happening in that region. But I think the long-term growth drivers behind Asia are really appealing, and the team at Schroders have shown that process has got longevity and can stand the test of time with almost whatever's been thrown at it for the last 20 years, which in Asia is a lot.
Yeah, so I was going to ask, when you move into more developing markets as opposed to developed markets, that's, you're taking more risk for potentially more reward. Just why is it riskier to be in those markets? Just so that our listeners can sort of understand why it is that's the case.
I mean, if you are getting away from investing in, say, the UK, then immediately, as soon as you invest overseas, you are introducing things like currency risk. So, it's not just the performance of the underlying company that's going to drive your returns. It's actually then the performance of sterling versus whichever overseas currency you are exposed to. So you're introducing a different risk. You're introducing different accounting standards. You're introducing different cultures in terms of how business is done. You're introducing very much in different demographics that are involved here. Now, I think there was a school of thought for a very long period of time that if you went to countries like Asia and emerging markets, you were taking significantly more risk because who knows how business is done over there. And yeah, these are kind of questions that I remember when I was sat in meetings years and years ago, the kind of things that accusations would have been thrown. But I think now, if we sit here and look at the last 20 years, developed markets have had their fair share of corporate scandals. They've had bankruptcies, they've had outright frauds. We're in no position to kind of sit here and moralize about accounting standards and how you run businesses. So I think those risks, you kind of just have to accept that it's an investment risk, and it's not particularly higher or lower compared to investing here. But obviously, investing in a country like China, you are introducing some other risks, obviously around the way the government operates in China is very different to the UK and the US and so on. So there are more risks in some respects, but they are also different risks, the types of risks that you face when you're investing in something like a UK equity fund.
Okay, and then the final area that I wanted to look at was income. We have had quite a long period of time, more than a decade, where income from bonds wasn't great, and a lot of investors opted therefore for dividends, for income from shares. But the situation's changed a bit now, with interest rates having risen and yields having risen. So I'm just wondering what your thoughts are here and what you would suggest.
Yeah, so bonds I think are interesting again. Yeah, bonds are now offering yields that are attractive relative to cash, and you're being compensated for the risk that you are taking. So, in the income space, I've selected a manager here who I've known a very long time, called Stephen Snowden, who runs the Artemis Corporate Bond Fund. Now this is an investment grade corporate bond fund, so it focuses on the higher quality companies that are issuing bonds in the UK or overseas, but they remove the currency risk by hedging that back to sterling. So you're not taking some of that currency risk we just talked about. Now, Stephen he ticks a lot of the boxes for me on those softer human characteristics. He is really tenacious. He wants to win. He never stops learning, and he's very, very humble when he's doing well, and he's honest enough to admit when he's got it wrong. So yeah, I like those characteristics in the manager. They come out, again, I've known him a very long period of time. He's someone I've invested with for my clients for, well, we're 2023, so I'm going to say almost the full 20 years I've been investing with Stephen Snowden as a corporate bond investor. And so I built up that trust and that relationship with him. I think he's a very, very good fixed interest manager. He's now hugely experienced, 20 years more so than when I first started investing with him there. And he's built a nice team at Artemis who are hungry to win. And you're getting a yield of more like 4 to 5% on investment grade corporate bonds today, whereas if we'd had this conversation a year ago, it would have been more like 2. So things have changed a lot in that space. But I think he's an example of an active fund manager who understands what he's doing and can deliver for investors.
Okay, well, just a final thing to say to our listeners and viewers, of course, these are not recommendations, they're just some ideas from Ryan here. Ryan Hughes, thanks very much.
Thanks for having me.